Sounds good.
Yeah. Hello, everyone. I'm delighted to have you today with us. And this is promising to be a really substantive conversation at the intersection of US business ambitions and European regulatory reality. Obviously, digital assets and the crypto space is maturing rapidly on both sides of the Atlantic. But the path for US companies to seek establishment of a meaningful presence in the EU is far from straightforward. The regulatory architecture is still complex, and the EU is far from fully harmonized in terms of regulatory law. The expectations of national and supranational regulators are often higher than anticipated, and the gap between sort of well-resourced legal strategy and actual operational readiness can be considerable. Today, we have assembled a panel of practitioners who bring real-world experience to these questions, not just theoretical framework, but hard-won insights from navigating licensing processes, structuring cross-border compliance frameworks and programs, and advising on token launches and building governance structures that satisfies demanding US and national competent regulators' expectations. Over the course of this session, we will walk you more or less through the life cycle and 8 agenda points that cover sort of the full life cycle of establishing a US presence. So that's the initial entry decision and what the actual landscape looked like in the EU in practice, compliance adaptation, fit and proper requirements, CASP licensing, token issuances, the regulatory tug of war between regulators' expectations and business realities, and last but not least, AML and crypto crime landscape inside of Europe. My aim is to draw you out some practical and concrete insights on what can actually be useful for you. So keeping us focused on moving forward through each topic in turn. With that, let's get started. I'd like to introduce to you my panelists here, and if I may start with the ladies, Rayissa. She's compliance director at Skylo, and maybe you say a few short words about yourself and in particular, your EU experience.
Thank you, Michael. It's a pleasure to be here. Hello, everyone. My name is Rayissa Armata. I work and have worked in the sectors between technology and government policymaking. So my career has focused on many different industries and sectors, both in the US and in the EU, and managing how technology policy is shaped and how that affects both regulatory processes and industries who are highly active in the tech sector. Thank you.
Right. Sarah, over to you, please.
Sarah, Absolutely a pleasure to be here. Thank you for having me. My name is Sarah Breslow. I lead the regulatory legal team at Paxos. Paxos is a digital asset infrastructure company. We both provide brokerage services as well as token issuance in the United States, where we're regulated by the Office of the Comptroller of the Currency, in Europe, where we are under the supervision of the FinFSA in Finland, as well as in Singapore under the Monetary Authority of Singapore. So pleasure to be here today talking about these interesting topics.
Right. Thank you, Sarah. And a lot of practical experience you probably have gathered entering the EU. And Andrew, over to you.
Yeah, it's great to be here. Andrew Jacobson, the General Counsel at Halliday. We are a non-custodial orchestration system. Started my career as an enforcement attorney at a bank regulator and have been in crypto for over 10 years now.
Thank you very much. So maybe the first topic is what actually surprises US companies when they contemplate entering the US. Maybe to kick off with something very specific, Rayissa, that there's differences between sort of identity verification in the US and Europe. How should companies rethink their approach if they want to enter?
Sure. Let me start off with maybe explaining a little bit of the background. As we see globally all over the last 20 plus years, we're moving into a digital society where everything from our services that we use traditionally are becoming digital. And what we've seen and what we hear a lot about in Europe are all these big overarching regulations from GDPR, Digital Services Act, anti-money laundering, EIDAS, DORA, NIS2, all of these big initiatives that are being implemented at the national level are Europe's way of handling the digital ecosystem. And moving from traditional regulations, you can't just fit them into digital applications. So there's a huge process that's going on. And part of that is identity verification. Identity verification in the traditional sense was a person went to a bank and opened a bank account and provided their identity to fulfill the know your customer obligations. And that changed and moved into a video-based agent explaining what prompts needed to be done so you could open a bank account online. And then that moved into a more automated system where users can use, in the United States, their driver's license, in the EU, their national ID cards or passports to open a bank account. But what happened in Europe is that these systems for the banks were fragmented. You had 27 different member states with 27 different processes and requirements for doing the same task, fulfilling a KYC obligation. So part of what is changing in Europe is this idea of harmonization and building trust through all these big regulations and building security. And a harmonized framework that's been introduced in the KYC identity verification sector for banking and other digital services has been a regulation called EIDAS 2, actually. And this is where digital identity, your passport, your driver's license, your national ID document is now stored in a wallet app. What that means is for Europe, there's a harmonized way to enable KYC. The system works to authenticate, to verify, and can be used to store other credentials. This is a system that should introduce a much more frictionless, easier onboarding, no more 24-hour waiting for your account to be opened. And the process is ongoing. These digital identity wallets will become more ubiquitous throughout all the different services. So for US firms coming into Europe, they need to be aware of the different identity processes that are existing today that are still enabled, but also this whole new digital identity wallet that can be used. So working with vendors who are able to adapt and offer an API that enables both reading this digital identity or using the more traditional online services will be very important. So I think in digital identity, like in all the other regulations that are coming, it's about trust and harmonization.
Thanks, Sarah. And that's obviously the first step of onboarding a client, but then there's probably, Sarah, there's more to know about sort of the level of harmonization throughout the EU or what US companies should prepare for in terms of continued relevance of national law and country level operational frictions. Can you talk a little bit about that?
Absolutely. It's very important coming in and thinking about what are the relevant questions that the regulators are going to be interested in the local jurisdictions. So in particular, you want to be thoughtful about what are the regulators looking for? What are the questions that are important locally, not just to the US company coming in from abroad? In particular, that includes that it's not a single marketplace. As Rayissa just mentioned, there's lots of different federal level regimes, but each local regulator will have their own particular interest as well. And so it's important not just to be thinking about what are the local practices in the union more broadly, but then also what do you need for local sensitivity?
Yeah, and if I understand correctly, most of the US companies that come into Europe, they will try to apply for a license in one country. And Sarah, you've done that, and you're currently in Finland with your company, and then all of a sudden you try to sort of win clients throughout the whole EU. And I understand sort of from a regulatory perspective, I think that seems to be done once you have the license. But if you go more broadly, then there are other regulations which are not necessarily financial regulations, like consumer protection, distance selling, and stuff like that. Can you have a word on that as well?
Yeah, of course. I mean, even obviously, everyone coming from outside of Europe thinks about GDPR and what does GDPR mean for the overall balance. But more broadly, what are the local payments laws? I think that as an outsider coming in, we had to become familiar very quickly with what are the local Finnish requirements in terms of the payments regulations there. We're regulated as an EMI, an electronic money institution, which permits stablecoin issuance in Europe. So thinking through what are those requirements, what are the different anti-money laundering requirements that you would see locally versus abroad, as well as, consumer protection is top of mind for every regulator, Michael. Undoubtedly, that is, the ultimate mission statement for those regulators.
Yeah, and consumer protection is not necessarily an area that is in all aspects harmonized throughout the EU. So if you want to sell to a Spanish client from Finland, then they may run into different consumer protection laws than you actually have in your EU home country. So the landscape seems to be more layered and therefore also more demanding than many US companies are anticipating when entering the EU market.
Exactly.
And these sort of are obviously practical challenges, and compliance programs need to be built around it. So coming from a US environment, the fundamentally different regulatory context also means that you need different frameworks, different policies, AML, the AML framework itself that we have talked about. So that is an important point. So talking a little bit about US compliance programs, Andrew, from a perspective of a general counsel as you are, what are the greatest challenges sort of for transposing US legal framework influenced policies into jurisdictions such as the EU?
Yeah, happy to jump on this one. I think historically, the greatest challenge was often taking EU products and bringing them into the US. And now I think it's probably the inverse, where you have a lot of US businesses because US law has gotten a lot clearer that now we're expanding to Europe. So I think about it from a principles perspective. As you noted, it's not always a one-to-one port in terms of what the US requires under the Bank Secrecy Act. It doesn't always apply one-to-one to what Europe requires, and same with privacy. The US has different rules that apply that and only apply to certain types of activities, whereas Europe has a much broader privacy framework. So I think at the first outset, you try to think what do you really want to do, and then work backwards from there. I think the second greatest challenge that I've seen in trying to do business in Europe is where do you start first? You've got a number of member states that all have their different rules. There's some member states that haven't even passed local rules implementing MiCA yet, and then you've got EEA states that have their own requirements. And so I think trying to figure out where do you start first, that's a great challenge. The approach I've always taken is I like to pick the most challenging jurisdiction and work backwards from there. Because and I've worked with Michael and his team in Germany, and there's some other member states where if you pick the hardest one, the most stringent requirements, usually you should be okay in other ones. But it's a great question, and something I think U.S. practitioners are not quite used to yet.
Yeah, and then obviously maybe what sort of areas if you try to determine, Andrew, what's the most challenging jurisdictions, are there certain areas of, let's say, unclarity on or ambiguity that you sort of encountered in your experience, where you say, okay, this is where you really challenged that actually one would hope that EU regulators give you some more guidance on?
I think a good example is I previously served as global head of legal at a crypto asset manager, and we had crypto ETFs, so physically backed ETFs, when these were not allowed in the U.S. to be exchange traded, and so the ETFs were issued out of Switzerland and then ported through Sweden, and you know the reason there are many reasons why you would do something like that. It doesn't always mean that the strict letter of the law is more favorable. It could also mean that the particular regulator or the exchange that has jurisdiction over these types of things is, you know, has more experience with these types of listings, has a staff that's maybe more willing to talk to you about them and willing to let certain types of activities go through. So in my experience, it's been typically, you know, when you deal with a government regulator, regardless of what the law says, you're still dealing with human beings. And so finding jurisdictions that have, you know, staff that have experience working in crypto, I think lends itself to companies having business success.
Yeah, and maybe to touch on another aspect again, Rayissa, on the AML framework, and what's maybe the hardest burden for compliance if you sort of compare the US FinCEN and BSA regime, that US companies are used to the regime for AML framework for crypto assets, and other obligations flowing from MiCA. What do you think on that front would be the hardest
Yeah,
to overcome?
absolutely. Taking on what Sarah and Andrew have said, I think first of all, the goals and the outcomes are supposed to be the same: mitigating fraud, combating money laundering, protecting users. But as Sarah and Andrew have pointed out, the legal structures are different, and also the operational mechanisms are different. So I think part of that is, I would say, a mindset. In the U.S., I think we're used to being more reactive. There's more room to be reactive, to use the courts as part of a tool to enable the business to grow and learn and make decisions from that. Whereas MiCA and AML require building operational systems from the start and using those from the start to finish. And those systems should be already in place and have the ability to handle the business, the customers, and what the expectations are. So I think that from the start, there's a different way of looking at things. For example, when you're looking at verifying customers, from the start, you need to be able to verify that a customer owns or controls a wallet for transfer of fund requirements. So there needs to be cryptographic verification in place. Because already at a lower threshold, at €1,000, there needs to be this type of function enabled. For the travel rule, Europe has a much lower threshold. In the US, I believe it's $3,000, and in the EU, starting at €0 or €1. If there's an exchange between different exchanges, you need to know who the originator and beneficiary are. So the KYC has to be carried already from the start. So those are sort of the operational thresholds that need to be met are from the start. Whereas in the US, we're looking at maybe starting in a very friendly state and building and growing. So as Andrew said, in Europe, you start with a challenging country and sort of enable all the operations to be met. And I think that's sort of the difference, is the challenge of looking at the mentality, as I would call it, which also means for engineers and the product teams, they already have to know what technologies are out there, what systems can they use, which ones have been tested. So it affects everyone from bottom down and bottom up.
Thank you. And both of you, Andrew and Rayissa, were talking already about sort of staff and persons acting. And that is not just sort of from a practical perspective, but there's also regulations around sort of certain people within EU licensed entities need to pass fit and proper requirements, in particular for board members and senior management. So this proves also to be certain there's certainly an area of gap between US companies, what US companies expect, and what European regulators actually demand. Maybe, Sarah, you can talk a little bit about what that means in terms of sort of assembling a board, finding the right people for EU-regulated entity. In particular, what it means that sort of EU regulators want genuine independence of those people on the ground, while maybe in the US the approach differs slightly in terms of what is typically considered to be a well-governed board.
Yeah, I don't know if it differs in the US so much on what is a well-governed board, but there are certainly local expectations of what board composition and what fit and proper looks like. In my view, the European regulators are looking for independence in substance, not just in form. So what that means is that not only is the director technically independent, not a part of the company, but also can they challenge management, exercise concerns, escalate concerns, exercise judgment, think through problems, and really feel autonomous without pressure from the United States or abroad. This is about having credible oversight and establishing through continuity of what the operations look like, having that clear oversight. They want to see that the regulators want to see in their reviews of the board that the non-executive directors are engaged and that they do feel empowered to say no when necessary. They're looking not just at resumes for those individuals, but what is their relevant experience. So the question really that you're asking as you're thinking about operations is not, do we have independent directors? That's an easy box to check, but rather, can we demonstrate the independent control of the EU regulated entity? And just on the harmonization points that we've been talking about previously, this does mean potentially having presence in the home country. So not just someone within the EU, although EU board members can be acceptable, but also do you have local home country independent board members? And that can potentially guide your decision on which jurisdiction you want to go into, because you want to make sure that there are credible, thoughtful, independent board members that will be present in the market in the country.
Yeah, and you mentioned, Sarah, that board members not just need to be independent, truly independent, but they also need to have certain expertise. And
Exactly.
so independency is maybe a matter of personality, but sort of expertise is also not necessarily only expertise in the US, but potentially also expertise to handle EU regulations.
Yes, and digital asset space in Europe is nascent. It's still growing. The expertise in MiCA is relatively new because it's new legislation. And so ensuring also that the board members can clear conflicts of interest potentially, because in a small space, in a small country, you need to ensure that there's no conflicts of interest for the fit and proper review as well.
Sounds to me as if it wasn't too easy to find those people, Andrew. What do you think? When should a US company start sort of searching for these individuals that can pass those fit and proper tests of EU regulators?
Early. Early. Anytime I've gone through a licensing process, you've got a number of different things that have to fall into place. Some of those things you can control, like policies and procedures, meaning you control the timeline, you control the drafting process. It's much harder to control human beings. It's much harder to control for talent. So, whenever I've gone through a licensing process, lining up executive talent, independent board directors, always like to do it really, really early. I think I'd add a couple of things off what Sarah said, which I think are really important. I think one, crypto's a new field. MiCA's new, but crypto's still very new as well. And so attracting talent to this space, attracting people that understand the technology and understand where the risk lies is very hard to find, even for non-independent directors. So you go to any company and finding exec talent in crypto is very hard. But most importantly, finding talent who has a real good sense of risk, meaning is this part of the product risky or not? Or is this part of the business or sales marketing process risky? That's not so it's not so one-to-one to traditional finance. And so that's why it's so important to have people that understand the technology quite well. But just to recap early, get those people in as quick as you can.
Yeah. Um, so that brings me to the question a little bit, what you think, maybe Sarah, is it more wise to acquire an existing entity with maybe people that have gone through this process and everything sort of being sort of in place, and then merge the US approach with the EU approach of an existing entity? Or is it sort of building a completely new EU platform? From your experience, what are the driving decision points here?
Yeah. I think it's important to take a step back when understanding that decision and asking what is the goal? Speed to market is obviously beneficial in an acquisition, but you really want to think about whether the structure of what you're acquiring fits your business needs within Europe. The acquisition does solve timing issues. It does ensure that you have the policies and procedures in place. You do not have the lengthy review process. Um, but you're not necessarily designing the governance model, the control frameworks, the operating structure, and you need to harmonize those within the home group companies as well. So the question you should be asking is not necessarily what gets me to market faster, although that is a relevant point, and more, where can we obtain regulatory durability and still support business strategy 2 to 3 years from now? So we did acquire an EMI in Finland, formerly Membrane Finance, and they were a great fit for us at the time because they were one of the only regulated stablecoin issuers matched directly with our business goals. And nevertheless, there's still always the challenges from an integration, including like just making sure that the tech stacks interact appropriately, and ensuring that some of the really important control frameworks in stablecoin issuance include mint burn operations, include reserve management, and harmonizing those takes a great deal longer than just the initial, okay, we have the license and we're able to issue. And so while we've been able to issue new stablecoins, including USDG, which is a regulated stablecoin in Europe, through the EMI, we still have some of the lingering questions about how do we resolve the tech issues that have persisted. Additionally, the market changes quickly, people in crypto change quickly, and so we have great staff on board, but only one person who previously worked at the former entity. And so you have to anticipate that at times people might want to move on and not necessarily work for a US group entity.
Mhm. Andrew, any thoughts from your perspective, how to sort of analyze market business benefits and regulatory requirements and the plan for entry?
Yes, Sarah had a great point around scalability of the business and particularly scalability of the product. And so, I think the best way to do it is principles-based approach. Every country that has a VASP law, virtual asset service provider type regime, has many things in common. So if you're not holding, someone's private keys, you're most likely not a custodian. If you're not, performing exchange type services, you're most likely not going to be a VASP. And there's some differences on a jurisdiction by jurisdiction level. But when I talk to product teams early in the product development process, we work backwards from some core principles that I know apply across dozens of jurisdictions. So that's really the first step. I think secondly, you think about who your customer's going to be in phase, P0 through, IPO scale? Are they institutional? Are they retail? Or is it B2B? Is it B2B to B2C? You name it. I think that really impacts how you approach a new market and what you're looking to do. And then I like to think about what's going to change. In the past, when I've done EU work from a product perspective, Mika was just a proposed rule. It was not implemented yet. So we were doing MiFID analyses, we were doing other type of regulatory analyses, and that would have been only 4, 5 years ago. Those rules have changed. And so thinking about does this particular jurisdiction for which you expect a lot of business activity have rules that are currently in place, or does it have rules that are going to be modified for which you have to change things? The great thing about Halliday is that we've got a general purpose system. The system itself is very flexible to adapt to the regulatory requirement of a particular regime. So that's a benefit that someone like us has. But many other products, many other systems are built for one particular jurisdiction. It doesn't always work for others. And so I like to start from a principles-based approach, but I think about scalability. When you're a GC and you're working with business teams, the last thing you want to tell someone is, well, you can just get into this country, but you can't really succeed. So scalability to me is the most important thing.
Okay, thank you. And yeah, sort of brings me to, if you decided to go for sort of licensing your own new business, because that was just the outcome of the analysis. That is something that obviously, as Sarah mentioned, is not the quickest approach. So it's demanding, it's time consuming, it's costly, you need to find the right people, not necessarily the easiest. So Sarah, what do US firms most often underestimate about the licensing process inside EU?
I think firms go into the licensing process clearly expecting a lot of paperwork, a lot of documents, a lot of policies and procedures. You look at a CASP or an EMI application, and there's about 100 different exhibits that you need to provide. And so it can very quickly become a large paperwork exercise. I think what is underestimated is then what is the follow-up on that paperwork? Okay, you've put all of your policies and procedures, all of your governance, all of your board requirements, all of your senior management into paperwork and framed your clear business plan and your program of operations. But what is actually the substance underneath that? I think the regulator questions can very quickly move into who is accountable, who are the decision makers, what is the genuine local governance and operational credibility, which can be a really tricky balancing act when you don't have operations currently in that jurisdiction, right? You're waiting on licensing in order to be able to stand up operations. And so it becomes very quickly an expensive exercise. But the regulator expectation is that you make those investments, even if you don't have revenue coming through that entity today, and you won't have that revenue until the entity stands up in full. You really need to move quickly in these applications to confirm not just what is the legal structure, where do decisions sit, who's accountable, when is the EU entity accountable, when is the global entity accountable, where is the framework embedded. And so all of these issues are really interconnected. Governance, compliance, staffing, outsourcing, risk, operational readiness, those are all points that will move together. So you really need to make sure that you are building an entity, not just putting points onto paper that say what that entity will be. You need to show that the operating model is real, not just something that is on paper.
Yeah, and obviously then once you got the license, it's not over. It's going to continue.
Exactly.
And that's also maybe something to consider in such a decision-making process, that an up and running entity, there has been already some supervisory engagements with your supervisor, while with newly set up entities, the planning needs to sort of be put into reality and real life as well. And Rayissa, maybe you were talking about sort of trust infrastructure. What role does that play? Not only sort of client for your clients, but also for the regulators, what you have in place and how it actually works in practice.
Yeah, exactly what Sarah and Andrew have been talking about. I think for Micah, for some of the larger firms, the challenge might be just getting the license. They have the resources to then have a staff, have the operational systems in place, use the technology, and it's easier for them to envision what happens next after the license. For some of the smaller or medium-sized firms, the challenge might also be, yes, getting the license, but understanding what happens afterwards. As Sarah was talking about, there are a lot of moving parts and they all need to connect. And I think for both small and large firms entering the EU, one of the moving parts is the glue, the transparency that needs to be shown from the firm side to the regulators and also to the end user. There needs to be transparency and building trust. And what could that be in an operational trust environment? Do you have the proper identity verification vendor to help you with KYC? KYC doesn't end with just the onboarding. There's verification that continues when you need to verify the customer owns a private wallet. Are you meeting the EIDAS, digital identity wallet requirements to enable that for end users to onboard and to continue their authentication? Do you have systems in place that you can share data with other exchanges? Is that being handled properly? So there needs to be transparency that touches in all of these different operational systems. So that is sometimes a challenge both for some of the smaller and larger firms after the licensing, sort of what happens afterwards. The technology needs to also support and meet what's happening on the executive and company level.
Yeah, and that obviously brings me to another question. Maybe Andrew, that's something for you because you already touched upon it. I mean, in the practical life of an entity, there's always sort of a little bit of a tug of war between what regulators expect and what businesses realistically can deliver. And one of the challenges, I think, in particular in crypto, is that okay, there's a history and there's maybe even already a product, and it's difficult to apply those different regulatory standards of the EU and its member states to the same product that is actually in the US, isn't it? So how do you go about that?
It's a really good question. Historically, crypto suffered obviously from shifting goalposts from a regulatory perspective, and it's meant that it's been very hard to demonstrate early on that you were compliant with law because it was really unclear in many ways which laws applied. So I think that led to what people call the gray area, where you had a lot of businesses that really couldn't proactively demonstrate they complied with anything. And you had a lot of customer type deals where being compliant with law was not the most important thing. I think that's changed now. I think being compliant with law is actually a winner of deals, and being able to demonstrate that, even for those in the DeFi space, which we operate, we're very proud to show that we can comply with MiCA, to show that we comply with US law, to show we comply with laws of many prominent jurisdictions. And so, I think it's gotten to the point where when companies in traditional finance go through a procurement process to win a deal, regulatory compliance was maybe top of the stack. Hasn't been that way in crypto for the past decade plus, but it's getting there now. I've noticed it as a deal winner. So I think that relieves the tension between, CEOs slash founders and the regulatory legal part of the business, where you can tell the CEO, hey, if we can demonstrate we comply with law, it's going to actually win a deal. And I've seen that happen pretty tremendously. I think another thing that's a challenge is, when you're a business person and you see someone else doing something, but you can't do it, you might say, well, why is that company allowed to do it, but I'm not? Historically, that's been allowed to occur in crypto, and it's very hard to answer that question because there just wasn't as much enforcement. The rules were unclear, but that's finally changing. The laws are much clearer now. So when you see someone else doing something wrong, you can't just throw up your arms. You can actually explain why they're not complying, and you can use that in the deal room to win. So I think there's a couple things that have changed in the course of blockchain, and I think it's for the better that it's starting to operate much more like traditional finance from a procurement perspective in deals.
Yeah, and just to sort of go back to the comparison between EU and US, I mean, it's in my experience, it has been always a big challenge to sort of bring a product that's been issued under US law rules to the EU and vice versa, because it's so different in the regime. Is there any sort of under MiCA, is there any convergence, or how do you see that currently?
It's a really, this is a great question. Historically, I'll give you a good example, which are crypto ETFs. Europe had crypto ETFs for much longer than the US did, meaning these were exchange traded, physically backed, investment vehicles. And I remember it was always the inverse. I remember talking to the SEC and trying to explain why these products should be available in the US. And they had a million questions of, well, how do we know it's not going to do this? How do we know it's not going to fail? And then I would just point to Europe and say, these have been in Europe for 7 years and have functioned pretty seamlessly. So I think the challenge historically was EU let a lot of innovation come early. US, I think, was behind. I think maybe things are changing a little bit where US products are getting a lot more traction, particularly on the tokenized equities front. The US is really pushing ahead there. So I guess to answer your question, it depends on the product. It depends on the segment of the market where the regulators are more attuned to. Stablecoins are a great example. Sarah could speak to this. The US really took the lead in stablecoins and had a stablecoin infrastructure from a regulatory perspective before many other jurisdictions. So I think it's market segment dependent. It's not always one-to-one.
Yeah, maybe Sarah, you can elaborate a little bit on that sort of stablecoin example, or what is the
Yeah,
most challenging on a practical perspective to bring a US stablecoin to the EU, or is it even possible?
yeah, it's challenging today, and I think it's interesting. Yes, New York DFS had a clear framework for regulated stablecoins in the U.S. starting in the early 2020s. But there has not been national guidance to date. And in fact, we have the Genius Act now passed. It's great, but we're still deep in rulemaking, which means that it's not clear today what can happen. Although, we're moving towards a clearer regulated structure in the US. I think the US actually did fall behind in some ways because they waited, and now the EU, there's a lot of complaints in the industry about MiCA more broadly for token issuance. There's a lot of things that are extremely that are very challenging about having a stable coin in the EU, including keeping 30% of reserves in cash in EU credit institutions, which is typically viewed as very high risk activity, keeping so much of customer assets in cash. You typically like to diversify those assets. There are other requirements as well, such that my understanding today is that there is a lot of discussion between the EU and the US about whether they are substantially similar regimes that will be able to be interchangeable when Genius is in effect. Today, we have USDG regulated in two jurisdictions in Singapore, under the Monetary Authority of Singapore, and in Europe, in Finland, and then passported through the EU. The challenge is, how do you add local regulatory regimes on top of existing regimes where they're contradictory? So, for example, bringing a US stablecoin into the EU, we don't keep 30% of stablecoin reserves as fiat cash in bank accounts in the US as a risk management policy. And so how do you comport that with the EU? How do you ensure that the regulators work together in the event of insolvency? So The other point is that, like, just from a practical perspective, the MiCA requirements for white paper issuance are extremely technical. You can't just list your US white paper in the EU. It is a much more rigorous um, exercise in disclosures, and including every possible disclosure you can imagine, and then also having it in a very particular format that is machine readable, that requires engineering teams to reformat the activities. So, if you're thinking about bringing a stable coin that is somewhere else into the EU, you need the regulators to be agreeing on what to do, and that is a challenging exercise, but not impossible. We did see that New York DFS just issued a memorandum of understanding with the European Banking Authority. So that will open avenues for EU issuers and US issuers regulated by New York DFS to collaborate. We also need to ensure that you have the risk controls and mitigations in practice such that you are thinking about how the tokens cross jurisdictions and when and where the reserves sit and at what time and when they're rebalanced. But a super challenging issue that is still developing regulatory guidance, I would say.
Okay, time is flying. We're already approaching the end of our panel. So maybe I can ask you, all of you, if you sort of look 5 years ahead from now and think about sort of what single capability would, if you really want to go global from the US to EU and even other areas, Asia, what single capability will make a crypto firm really successful in that approach? What do you think is the most important? Maybe Rayissa, you want to start?
Thank you. This has been a great discussion. I think from Andrew and Sarah's perspective, as they're experts in some of the day-to-day processes, I think I would say that overall, incorporating the mentality or the idea of operational trust, trust from the beginning to the end, so that all the different systems and all the different teams within the firm understand what transparency and trust actually means for European regulators and how that's done, whether it starts with the KYC identity verification, monitoring suspicious activity reports, exchanges, or moving from centralized to decentralized systems. All of that, there needs to be trust and transparency built into how the operational functions work.
Sarah, what's your view?
Yeah, I would say the one differentiator will be building regulatory credibility at scale. And so, what does that mean? You need to be treating governance, compliance, and legal infrastructure as something you're building today, because in 5 years, that will enable you down the road to enter new markets, both in the EU and abroad, and engage with regulators in a trust exercise, as Rayissa was just saying. So, long-term success is going to be ensuring that regulatory infrastructure has been built from day one such that the foundation and the base is really strong, and then you can build on top of that.
Andrew, your views?
Two things from my perspective. I think one, give traditional finance the permission to come on chain. And then two, when they do come on chain, give them the permission to do it via non-custodial architecture. I think it's very important that the law recognize two forms of architecture. One is regulated and centralized, and two would be decentralized, and in particular, truly non-custodial, where the user technically controls their funds and legally controls their funds. So I think having that parallel architecture will really be a great recipe for success. And I think investors, users, and customers really benefit from that long term.
Thank you very much for all your insights. And maybe to wrap it up, I mean, maybe I can summarize this panel as follows. The first point is that is of relevance is that you shouldn't underestimate, as a US company, the process of entering the EU market. So it can be much more demanding and expensive and lengthy and complex than you may have anticipated. Maybe secondly, there's a persistent complexity due to local laws still being applicable inside EU. So it's not fully harmonized. It doesn't all follow the same rules. And maybe as a third point, that you need to have these real presence substance inside EU. So there's no way of escaping local entity requirements, local management requirements, and things like that, people that are fit and proper. We've also talked about the legal framework still evolving, so also from a sort of naturally global product that crypto typically is, there's still frictions between the regulations. The same product cannot be sold, marketed, etc., in all jurisdictions for the reason of the divergency of rules and regulations. Yeah, I think that was great learning for us, and thank you again, Rayissa, Sarah, and Andrew, for joining me on this panel today. And I hope you had a little fun. I learned a lot, and thank you very much for the audience for listening in.
Thank you so much.
Thank you, Michael.
Likewise, thank you.
Bye, everyone.
Thank you. Bye-bye.
Yeah, thank you, everyone.